So, welcome back to the Investing Markets and Money podcast brought to you by the Armchair Trader. And this week we're talking about the US market, US stock market. And on the podcast, we're very privileged to welcome Cathie Wood, who is CEO of ARK Invest in the US. Arguably, I think, one of the most high-profile fund managers in the world at the moment. Welcome to the podcast, Cathie. Thanks for joining us.
Thank you, Stuart. Yes, high profile for all kinds of reasons. So yes, thank you.
Well, arguably, I think in the last 4 years, probably one of the most talked about, certainly here in the UK and as well as in the US. But having said that, some of our listeners probably haven't heard of you. So it would be great if you could just give us a little bit of background on ARK for those not familiar with it.
Sure. ARK is 10 years old. I founded it in 2014 for two reasons. One, to focus exclusively on truly disruptive innovation, so technologically enabled innovation. I felt, and with my team, we felt that the seeds that were planted in the 20 years that ended in the tech and telecom bubble, they had been germinating for 20, 30 years, and they were ready for prime time. So we focused around robotics, energy storage, artificial intelligence, blockchain technology, and multiomics sequencing in the life science space. Multiomics means not only focusing on DNA, but also RNA, proteins, methylation, very complicated. And more important, the convergence among these platforms is going to create multi-trillion-dollar opportunities. The best example of that is Tesla. Tesla embodies three of the five platforms: robotics, autonomous vehicles, and that is where we're going, are robots. Energy storage, they will be electric. The cost of ownership of an EV has dropped below that of a gas-powered car. And three, they'll be powered by artificial intelligence. So the way to think about that is we have three S curves in the world of innovation. Innovation starts slowly and then all at once. And that steep part of the curve is where we are heading, we think, for many, many companies and technologies. So effectively, with convergence, we've got one S curve feeding another S curve, feeding another S curve. So that was the first reason I started ARK. There's not enough research being done in this realm. And there's huge inefficiencies in the market in terms of pricing these opportunities if one has a long-term time horizon. And then the second reason was really to transform this idea of research, make it open source. So the world I grew up in the traditional financial world, housed research internally. And that was at a time I started in the business a very long time ago, late 70s, early 80s, when information was dear. It was difficult to get. It was expensive to get. That is no longer true. And so we don't think research can be housed within one institution. We have open sourced our research. We give it away. And we give it away on social media. I never believed when we first started that X, then Twitter, would be the most prolific social network for our conversations about innovation, but it is. And so we are getting back much more than we are giving when we put our research out there. We get a lot of feedback and insights from those who are in the field actually innovating.
And you've recently launched into Europe as well with some ETF products. It's your sort of first venture in the European market. ETFs as an investment product here in Europe are still very much passive vehicles, tracking indexes. There's a lot of focus on the mainstream US indexes, the S&P 500. Do you think that these indexes that many ETFs currently track are really reflective of what's happening in the US stock market at the moment?
Well, first of all, I'd like to talk a little bit about our acquisition in the UK, a little gem that we plucked out of Asset Co. It was called Rise, Rize, known for its focus as an indexed player on mega trends and on sustainability. And I think we got a, a, a lot more than we even appreciated at the time, because in the months, and it's we're coming on a year now since we acquired Rise. We have learned that their reputation in sustainability is one of the best throughout the UK and Europe. And the way we see this is more than 75% of their funds, excluding the new ARK funds, but more than 75% of their funds are Article 9 funds. That's very different from most organizations. I would say, less than 10% of the average is Article 9. And that's the highest level of sustainability that companies exist to really foster sustainability. It's a primary focus, a mission. Our funds, the three that we launched, are Article 8 funds. We are inherently sustainable. Innovation is always about solving problems. It solves problems. And so you'll see we have no energy stocks from the beginning, because we do think the world is going electric. And that's just one example. So thrilled with the acquisition. Then your question about in the US, do the stock indexes represent the market? Well, yes, they represent the market, but they are short massively. And so short means betting against the idea of truly disruptive innovation. So if you look at the indexes as they are constructed now, and as they have evolved, you'll see there has been massive concentration towards we call it the Mag 6. You've heard Mag 7. That one includes Tesla. Tesla got kicked out of the mags because it hasn't been straight up and to the right. It is much more volatile a stock. But you've got the meta platforms, Apple, Amazon, Microsoft, Nvidia, and I know I'm escaping one. They are so concentrated in these benchmarks that the various index providers are saying, okay, this is too much risk. These are too concentrated, and they're trying to do something about it. To give you a sense of the drama here, if you look at, and this is a Goldman Sachs study, if you look at the highest the valued stock, meaning the highest market cap in all of the US market, no matter where they're listed, and you compare that to the 75th percentile stock to get a sense of this concentration, last year we were more concentrated, and early this year, more concentrated than the market was during the Great Depression. Now, what does that tell us? Well, in the Great Depression, from 1929 to 1932, when the peak concentration occurred, there was only one question being asked when unemployment hit 25%, GDP collapsed 30%, and price, the deflation, was 25 to 30%. The question back then was, okay, is this company going to survive or not? And of course, cash was king. AT&T was at the top of the pack. A little bit similarly now, as interest rates skyrocketed, they went up 24-fold in little more than a year's time. No one knew what the ramifications of that was going to be, or were going to be. And so there was a crowding in to stocks, mega tech stocks, with very strong cash flows and huge cash cushions. And oh, by the way, maybe they'll get a little bit of this AI thing going on out there. And so that's how we hit the concentration. Our flagship strategy is very little exposure to the Mag 6. The average large cap active manager in the US has 48%. This is a Morningstar number as of June 30th, I think. 48% in those six stocks. From our point of view, that's a lot of risk, right? And it's been at the expense, the shift into those stocks has been at the expense of our stocks. Our stocks are the innovators who we think will become the mega tech stocks. Except they won't be just mega tech. They're going to be mega because of all of the convergences taking place out there. So we think that if you look at the history of the concentration in the markets, it can either end in a bear market, which it did in 1973 when we lost the Nifty 50, and in 2000 when the tech and telecom bubble burst, or the rest of the times, and there are probably another 5 times. What typically happens is as the concentration lessens, it is because of a broadening out in the bull market. And our vote is on that outcome, and that should accrue to the benefit of our strategies.
We've just had a presidential debate in the US. It's being discussed widely here in the UK, and I'm sure in a lot of other countries. And we see a lot of output from the analyst community speculating about the likely impact on US stocks, volatility in US stocks in the course of the ongoing presidential election campaign. What sort of impact do you think, regardless of the outcome? I mean, what sort of impact do you think that's going to have on the stock market?
Yes. Well, on the stock market broadly, I have one answer, and then on our strategies, perhaps another. On the stock, so there are two distinct paths evolving here. One is lower tax rates, much lower regulation, and that's very capital friendly. The other one is, I would say, more government intervention, specifically in housing, for example. There's a huge shortage of housing. So, really trying to direct incentives towards specific sectors and specific problems. And I think that one will accrue to the benefit of perhaps sectors as opposed to the entire market, because it probably means higher tax rates and maybe more regulation. We don't know. When it comes to the world of innovation, what we are seeing is, and what both sides of the aisle agree with, and there's very little agreement, as you know, is that innovation solves problems. And who's going to be against innovation? Even when it comes to the digital assets world, what some people call crypto assets, um, we did have a bifurcation in terms of one side of the aisle pro and the other side of the aisle against. That even has changed because in the course of the debate, it's become obvious that this is a source of innovation that is going to lower costs and increase productivity. So even that one, which was the most controversial of our innovation platforms, even that one is turning more bipartisan. So we're hopeful on that score.
And another big piece of news that's been out recently that a lot of people took on board was Warren Buffett announcing he was cutting the size in some of his positions, and there were some big blue chip names he was selling, the likes of Apple, Chevron, Capital One, and it's prompted a lot of discussion here in the UK, where we have a lot of investors where the top 5 holdings are actually US stocks at the moment, usually high quality blue chips. And this is Warren Buffett's actions have got some people almost second guessing themselves. Do you think that that's an indication that things are changing as well as he's reversing out of some of those traditional names?
What's interesting about this move is most people up to this point have been saying, "What are you going to do with all of your cash?" Because he has so much cash building up. And he's basically said, "Oh, we'll bide our time." So the fact that he's actually cashing out on some of his existing holdings is interesting. Um, so, and as we've been thinking about it, he's very valuation sensitive. If you look at the Mag 6, and Apple is among them, then those are very expensive relative to their histories and probably have incorporated the benefits of AI as a tool in these various platforms. So I would say that's an answer there. It may be that he's becoming more bearish on energy prices when it comes to Chevron. Energy prices are breaking down. And I think that as more people do analysis on the impact of electric vehicles, that they're probably going to conclude that demand has been peaking out for the last few years and actually could fall in a secular sense. So that could be there. And then financials, Capital One, Bank of America. We're puzzled about that one, mostly because lower interest rate environments tend to be good for financials. Sure, their net interest margins come under pressure, but then loan activity is also picking up. So there are puts and takes. And so we wonder if the sale of some of the financials is because of some concern about excesses that are taking place in financial markets, mostly because of private credit and private equity. We see walls of money moving into both of those, and they are changing the valuations of companies, and they might be obfuscating some underlying credit problems. Now, when we look at the high yield credit spread, which is a measure of risk in the market, it is very low by historical standards and actually a source of comfort as we watch the equity market worry. Usually it's the opposite. The credit markets start worrying before the equity markets. And we've seen in the equity markets this worry expressed in the concentration towards very cash rich names. Um, Maybe this time, maybe the credit markets, because of the money gushing into those spaces, which do not have to market like we do every day. So a lot of money is moving into those markets. Maybe those are that gusher is obfuscating some of the credit risks out there. We know where they are. We know commercial real estate is in a world of hurt, offices very clearly, but even now, overbuilding in multifamily apartments, if interest rates come down and really change the dynamics of the housing market, we have a massive housing shortage right now. But if interest rates come down enough, the builders are going to start building and existing homes are going to start turning over because people can't afford to turn over their homes right now. Mortgage rates are locked in at such low levels. If many people moved, they'd end up paying triple the rates that they currently are paying. So, because I know, unlike in the UK, most of our mortgages are fixed in terms of the interest rates, so nobody's moving. I think that might expose some of the weaknesses in multifamily as we get renters who have had no choice but to rent moving into homes. That's where we may see some of the credit risk. I know that's a long answer to your question, but it is provocative that Warren Buffett is raising more cash when he already had a lot on the sidelines. And he tends to be a bargain hunter. So I'm sure valuation is part of it, but maybe making calls on energy prices or feeling less comfortable that they are up and to the right, which they have not been, and the risks within the financial services sector in the form of credit risks. He may be expressing those in terms of selling these names.
And we've touched on it very briefly already, but we seem to be in a period of unprecedented scrutiny of the Federal Reserve and what the Fed's going to do next. As we're recording this, it's looking increasingly likely that the Fed will start to cut US rates. What does that mean for US equities?
Yes. Well, what's interesting when typically when the Fed starts cutting rates in any cycle, and yes, we do agree they will cut next week. We're what typically we're heading into a recession, and lower rates do not prevent a recession. But one of the reasons the recession happens is, people are sitting back and saying, okay, they're going to cut rates. How low are those rates going to go? Maybe I'll just wait and buy this big, buy an auto or buy a house until I see how low rates go. So it actually exacerbates a recession. Now, we've been through a rolling recession here in the United States since the moment the Fed started raising rates. Housing is in an outright depression. We are down near '08, '09 lows. Commercial real estate, world of hurt. Autos, autos are basically subpar. They are not, typically they peak and stabilize in the 17.5 million unit range. That's an annualized rate. Right now they're 15, and they typically bottom in the 12, $13 million range. Very mature industry. That wasn't dollar, that was unit range. So we're halfway there in autos already. And so really what we have now, capital spending is already falling. The last sector to go would be the consumer. And what's interesting about this time around, the consumer is responding to lower prices. We're beginning to see deflation in the US economy for many consumer categories, especially consumer goods. And the hopeful sign here is the consumer's responding. If you give the consumer a good deal, cut those prices 10%, the consumer will buy. Now, the problem with that, though, is if companies are cutting prices, then unless commodity prices and others are coming down enough, and they are coming down, the odds are high that margins are going to come down, and companies may resort to laying off people they've been hoarding since COVID because it was so hard to get them. So that could happen. Now, how much has the market already discounted this? I can tell you the internal dynamics of the market have been suggesting extreme caution when it comes to the equity markets in the form of this concentration. So I would say we've discounted some. You never discount all, and we don't know how bad it will be. But I would say over the next year, if you were to ask me, is the market going to be up 1 year from now or down? I believe it will be up, but the complexion will change completely, or the dynamics. I think there will be a broadening out, and maybe some of these mega tech names mark time. Maybe they're going to be disrupted themselves. That's what many people are not expecting. But we think a name like Alphabet is going to be disrupted mightily by artificial intelligence. Even Apple could be disrupted as maybe the apps aren't going to be as useful if we can just go to whatever website we use in an AI prompt. So there are questions that I don't think have been researched enough in the traditional financial world, which could actually cause a correction in some of the mega caps. Not all of them, but some.
And artificial intelligence, obviously, this is a revolution changing the world at the moment. A lot of investors, particularly private investors, are encapsulating that by just buying Nvidia shares. That's kind of their way into that story. But as we've mentioned, Nvidia are already looking, I mean, certainly as from my perspective, highly overvalued. From your perspective, how can investors who are interested in AI may not know, an awful lot about it, but how could they benefit from this technological revolution?
Well, it's interesting. We have set up an AI fund. It's ARKI in Europe, and it's especially for Europe. We do not have this fund in the United States because when we started 10 years ago, the AI revolution and the blockchain revolutions were not really evident. And so we have a fund called the Next Generation Internet, which includes both of those. But we have one in Europe, ARKI, which is our fund for artificial intelligence and robotics, because we think there's a massive convergence between those two. And you'll see while we do own some of the mega caps there, I think the only one that is in the top 10 is Meta, because we are so impressed by its open source large language models that it is offering for free out there. And then you'll see developers developing on its platform. It then can take that large language model and use it to specialize for its consumer models. Large language models are used primarily for enterprises. Now we're talking about the consumer space with Meta, and we think there are huge opportunities in the consumer space. So I think a differentiated exposure to artificial intelligence that we have accomplished in that fund. And one of the interesting things about AI is robotics. The way we see it, couldn't happen the way we believe it's going to happen without AI. And we think that is going to be the fastest growing part of the AI revolution over the next, between now and 2030. And you can see this in our Big Ideas 2024. We put it out every January. We see that AI focused market valuations, we believe, over the next 5 to 6 years are going to deliver a return in the mid to high 30s per year. Robotics, we see more than 75% because it is at such a low base right now, and we think it's going to be explosive during the next 5 to 10 years.
Well, that sounds very exciting indeed. And before we let you go, one final question. The ETF market itself is changing a little bit, particularly in the US, but I expect these changes to happen here in Europe as well, with more active ETFs coming onto the market where managers are given much more control over the portfolio. They're not just passively tracking an index. What's your view of that, and what sort of impact will that have on the ETF industry and for investors in ETFs?
Yes, very interesting. 10 years ago, when we launched ARK, our ETFs were the first truly active, fully transparent ETFs in the market. Most people thought that was not going to work. And I think they've done a double take. And it's been interesting. It's taken 7 to 10 years, but now there is a flood of active equity ETFs in the market because we do think there's a shift brewing away from passive and toward active. And why would that happen? It would happen for the same reason the S&P did not discover Tesla until it hit $500 billion in market cap. A lot of earlier stage companies are investing aggressively right now, and we think it's extremely important that they do so. Because of that, they're sacrificing short-term profitability, and the S&P and other index providers have requirements about profitability, whether it's a 4-quarter moving average of profitability, with the last one being profitable. There are different ones for different index providers. So they're going to miss a lot of these names in the early stages, that zero to, in the case of Tesla, $500 billion range, when there are true surprises and it is significantly volatile, no question about it. But volatility on the upside is a very good thing. We have seen volatility on the downside for the most part for the last 3 years. And volatility does not happen in one direction. So we do think we're setting up as risk appetites pick up, this concentration diminishes. We are setting up for significant surprises on the upside of expectations from these companies. So I think more and more managers recognize, wow, we better get some of our active strategies into an ETF format, because ETFs are very investor friendly, from a liquidity point of view, a cost effectiveness point of view. For some here in the United States, definitely a tax effectiveness point of view and a liquidity point of view. You can trade all day long, whereas with mutual funds, it's once a day. So I think that there's demand pull now for active strategies in the ETF wrapper, which is a great wrapper. I can tell you, as a portfolio manager, I love it so much better than mutual funds for a portfolio manager. Why? Now, I know it's a little different in the UK and Europe, but in the US, we have an ecosystem around us. Really, we outsource the market making. Well, there are always market makers, but it is the market makers and the authorized participants who handle our flows. I don't have to worry about flows. They use all kinds of sophisticated techniques, including AI and algorithms, in order to accommodate flows, whether they're inflows or outflows. So it's marvelous. The portfolio manager does not have to worry about flows here.
Oh, fantastic. Well, thank you very much indeed for your time this afternoon, Cathie. Really appreciate you coming on the podcast and talking about some of the hot issues of the day.
Well, thank you, Stuart. Thank you for giving me and ARK this opportunity. And thank you for doing such great research on ARK.
You've been listening to the Armchair Trader podcast. Make sure you visit our website, www.thearmchairtrader.com, for your daily dose of financial markets news and sign up to our free newsletter there.